You might have clicked on this video because you're holding Invitae stock and your position is significantly underwater. Well, welcome to the club. Invitae has sunk 80% over the past 6 months, and our position is currently 86% underwater. What that means is we'd need to see a 600% stock price appreciation just to break even on our money. So these are paper losses, and we always say don't sweat paper losses, but realistically, we're all human, and of course, we sweat paper losses. So today we want to talk about why the stock might be crashing, and it's not just because it was overvalued. There's some other concerns we have in digging through the financials. Now, let's start out with the good news. That is, checking in with Invitae, as we do with all our stocks at least once a year, we see that revenue growth is still strong. And revenue growth is not optional for disruptive tech companies, right? They need to be capturing market share, they need to be growing revenues. Now, when capital was easy to access and cheap, then growth was our sole focus. Now that capital is drying up, we want to see that companies can survive, and that's the concern that we're going to talk about today. So, checking in, we see that Invitae has growth of 40% based on 2022 guidance. That's great. So, hopefully we'll hit that. In a previous piece, we looked at how quickly they're growing compared to the competition. So it's great to see that they're capturing market share and continuing to hold their leadership position. Now, where the concerns lie are in the cash that they have on hand based on what they need. So this was a slide from their most recent investor deck that accompanied Q1 2022 earnings, and it talks about their cash runway. Now, we're assuming these green bars either represent the cash they have left over or the cash they're going to need. The takeaway here is that they're talking about extending their cash runway, as they should be. And one of the bullet points here refers to gross margin. Well, we did an analysis of all the companies in our portfolio. We're holding 35 tech stocks right now. Invitae had one of the lowest gross margins of all the stocks we're holding at 21%. And that actually prompted us to take a look at the company. And I'll put a link to the research piece that we did that this video was based on. So gross margin expansion, Invitae knows they need to increase that gross margin if they ever have a chance of achieving profitability. And they mentioned some other bits, and you can listen to their earnings call, or you can read the transcript, and the CEO talks about extending their runway through 2023 and potentially beyond. So it's clear that they're thinking they'll have enough cash to get through 2023, but the big concern is 2024. And we'll talk about that in a second. Now, when they expect to achieve profitability, that's not until 2025. And that's still a question. Like, that's a target. That's not given. So you see here, this is another slide from that investor deck that says reaching positive operating cash flow by 2025. That's 3 years from now. So we can do some back of the napkin math. As of the last quarter, they had $885 million in cash. They burned, that's after they burned 169 million last quarter. So if they're anticipating burning 600 million, that's on the low end of that guidance. It could be up to 650, but we used the low end. If they're anticipating burning 600 million total in 2022, that means they should exit this year with 431 million on their books. Well, let's say next year they can cut their cash burn in half. That's pretty aggressive. Then that will leave them with 131 million going into 2024. That's not a lot. And the problem that they're going to have that year is that a whole bunch of debt comes due. So they have nearly $500 million due in 2024. We've highlighted 3 interesting bits here. The $1.15 billion in convertible senior notes that comes due in 2028, that was from SoftBank. Well, guess what? SoftBank no longer has the deep pockets that they had before. So one would have hoped that all that cash would be on Invitae's balance sheet so that they could survive going through the difficult times that lie ahead. That's not the case. We also see 350 million in convertible senior notes coming due, and this 2020 term loan. We wanted to talk a little bit about that because it seems a bit irresponsible. So they took on this, what's called the 2020 term loan, with a firm that extends credit to other firms with some pretty interesting restrictions. So you can go into the SEC filings and pull this document up yourselves and take a look at it. Now, we know it's only $135 million and that they're going to pay that off. How remains to be seen in 2024, but this is quite restrictive. So it talks about things like, and you can see the negative covenants on the left, and try to read through those. It becomes very difficult to navigate all that language, but you can see on the right here, we pulled out a couple covenants. This minimum liquidity, they have to maintain a minimum balance of cash. They have to have minimum revenues per quarter, and the numbers aren't provided. But then when you look at the actual interest rate, it's a 2% LIBOR floor plus a margin of 8.75%. And there's interest rate risk associated with that, which is quite surprising. So even though they took all these strict terms, they didn't even get a decent fixed interest rate. You wonder why they would let themselves be put in this position for just $135 million when they had a $1.15 billion convertible note raise from SoftBank, and they were selling shares upwards of $40 a share back then to raise cash. So why they allowed themselves to be put into this loan, which has a lot of restrictions, especially around how they might raise capital going forward, it's somewhat of a concern. Now, the company themselves makes it a point, and when you read through their 10Q, you could see where they talk about some of the risks that they're facing based on having taken on debt with restrictions. So here's a point they make to say that their capital options may be limited going forward. And you could see the terms of our credit agreement restrict our ability to incur certain indebtedness and issue certain equity securities. Now, so there's two ways that they can raise capital, right? And they'll probably need to raise capital. If anything, they're going to need to refinance all that debt they have on their balance sheet. But raising capital would come from two sources. It would either come from debt, so raising more debt, that doesn't sound very good, or it would come from selling shares. Well, guess what? They're no longer selling shares at $40 a share. They're selling shares at $3.40 a share. That's a problem, because that means they have to sell a whole lot more shares to raise money and dilute existing shareholders. And we believe that the drop in share price would be investors realizing that. So dilution, right? Cohen and Company, it's an investment bank that they work with, is authorized to sell up to $400 million in shares at Invitae's discretion. Well, if you do the math on that, the outstanding shares increase significantly if they're going to sell $400 million in shares at today's prices. So as of last quarter, they had 228.8 million shares outstanding. That's up 16% from the same period in the year prior. Investors need to watch this number closely for further dilution. Now, in looking at Invitae, and people will probably ask, you could probably put people into two camps: those who are looking at purchasing Invitae now and saying, wow, it's at bargain prices, and those who are holding a position underwater, or perhaps those who just entered a position. And we're going to talk about how we think about our own position. All right. Here's three scenarios as we see it. So our thesis hasn't changed. We're not selling our position. We're sticking with it. So there's three outcomes. One is that they go bankrupt. So maybe they default on debt and everything goes pear-shaped. And let's say we lost all our money for some reason. Well, if we look at the amount of capital we've deployed in our Invitae position versus the total value of our portfolio at the moment, and tech stocks make up about 14% of our total portfolio, our exposure to Invitae is 0.66%. That's how much capital we stand to lose. So guess what? We're not sweating those paper losses. And this is why you should have limits on the amount of capital you put into any single stock. Tech investing is risky. We can expect there to be some blowups. Now, we're risk-averse tech investors, so we're hoping to avoid blowups. And again, there's no need to be doing a post-mortem until the big, beautiful woman sings. But that's one outcome, that they could go bust. And then we could say, all right, what mistakes did we make getting into this position? The second outcome could be that they get acquired. Let's say they got acquired at a 200% premium tomorrow. That means that would lock in losses on our position of over 50%. So Invitae getting acquired doesn't necessarily benefit us. Somebody raised this in an ARC webinar recently, and ARC's response was, well, we'll fight to make sure that doesn't happen. In other words, with tech stocks crumbling, companies step in to acquire cheap assets, and investors who are holding for the long term get screwed. ARC's response is, well, as a major shareholder in these companies, we'll fight to make sure that doesn't happen. That's great to hear. And they gave an example, I think, of Illumina. They were successful in doing that with Illumina before. And then the third outcome here would be that our Invitae thesis changes or growth stalls. Now, if something bad happens and growth stalls or our thesis changes, there's not going to be a lot of dollar value left to sell at this point. So in any of these outcomes where, these are all the bad scenarios, and of course there's the ideal scenario where shares, rise upwards of 600%, we get our money back in a little bit, or we get a lot of our money back because 10 years down the road, they're a leader in what they do. I think their market cap now is under $1 billion. So they've really started to hit the skids. But be that as it may, that's where we sit. The conclusion is that Invitae took on some really restrictive debt obligations, and hopefully they'll be able to work their way out of that. They raised a lot of money from SoftBank. That was easy money. Everybody was able to raise money from SoftBank. They should have kept more cash on hand. What they ended up doing was making a whole bunch of acquisitions. Now they're left with a big pile of debt and a share price that doesn't do them any favor. So if they want to raise money by selling shares, they're going to be significantly diluting existing investors. Positive operating cash flow by 2025? Let's certainly hope so. And in listening to the earnings call, it wasn't overly convincing. That's a target, and that's great that you can have that target, but that's a pretty significant achievement if that actually happens. So they need to focus on surviving, and they've clearly identified that. It's great to see, and they're hoping to survive while continue growing. That's great. They need to cut the fat and put the company in a better position so that investors have more confidence in the firm, because ultimately the price of a stock is only what investors are willing to pay for it. So please put your comments in the comment section. I'll put a link to the research piece used for this video in the description of the video. Thank you very much for taking the time to watch this video today.